the timing couldn't be more appropriate because we're at a turning point. The timing to talk about these issues is extremely good. And right now, as we speak, the Federal Reserve Chairman and the Treasury Secretary and everyone else in town has been very, very busy. Very busy doing more about this debt crisis than any of their predecessors have done about any debt crisis in the history of the country. And yet, it's not enough. But at the same time, it's too much. And that's the crux of what I have to say today. 2 years ago, when major banks announced multi-billion-dollar losses in the subprime mortgages, the Fed and the European banks, if you recall, injected unprecedented amounts of cash into the world's markets, world's financial markets. But it wasn't enough. So 1 year ago, when Bear Stearns went under, the Federal Reserve broke with tradition and became the lender of last resort to almost every major brokerage firm on Wall Street. It wasn't enough. 6 months ago, when Lehman Brothers and AIG failed, Congress rushed to pass the greatest bank bailout legislation of all time, TARP. But that wasn't enough either. Since then, in addition to the original TARP, and to some degree overlapping with that TARP, the U.S. government has loaned, invested, committed, promised $400 billion to nationalize the world's two largest mortgage companies, $42 billion for the big three auto manufacturers, $29 billion for Bear Stearns, $185 billion for AIG, $350 billion for Citigroup, $300 billion for the Federal Housing Administration, Rescue Bill, $87 billion to pay back J.P. Morgan Chase for the bad Lehman trades they picked up, $200 billion loans to banks under the Federal Reserve's term auction facility, the TAF, $50 billion to support the short-term IOUs of some money market funds, $620 billion in currency swaps for a whole list of industrial nations. I won't wade through them. $120 billion in swaps for emerging markets, a few trillion more to cover the contingent liabilities and expanded deposit insurance and other sweeping guarantees. And it still wasn't enough. Then just yesterday, to confirm, to underscore the fact that it wasn't enough, the Federal Reserve committed to buying $300 billion in long-term Treasury bonds and an additional $750 billion in agency mortgage-backed bonds, plus $100 billion more in GSE bonds. But I can tell you flatly right here and now, it is still not enough. It's not enough because even if you include yesterday's $1 trillion and change that the Fed announced in additional purchases, the total tally of the government funds committed so far is closing in on $13 trillion. But the Federal Reserve in its latest flow of funds tells us that since this crisis began, the wealth destruction at the household level in the United States has been, guess what? Coincidentally, about $13 trillion. So all the money that's been promised is already gone, in one sense. And it's also not enough because, as we all know, only some fraction of the money that's been committed has actually been spent or lent. And only some fraction of that has actually reached its final destination, the end consumer or the end business person. But on the wealth destruction side, that's a different story. On the wealth destruction side, it has already hit home, quite literally, and quite specifically, the households of American households. So it's also not enough because, as we demonstrate in this paper, the FDIC, in our opinion, is significantly understating the number of banks in this country with assets, with number of banks in this country that are at risk with assets of totaling $159 billion. Our objective analysis with their database turns up 1,568 banks and thrifts at risk of failure with assets of $2.3 trillion, not $159 billion. It's also not enough money because AIG is very big, but AIG is not alone. in the strictly confidential memo that the AIG issued on February 26th, they made the case that their $2 trillion in credit default swaps could have been the big event that might have blown up the world financial system. But as I demonstrate in this paper, Citigroup has $2.9 trillion in credit default swaps, which is almost $1 trillion more than AIG had at its peak. JP Morgan Chase has $9.2 trillion in credit default swaps, or almost 5 times what AIG had at its peak. The money that the federal government is so busily committing and spending right now is also not enough because AIG's counterparties are not alone. AIG's counterparties have a total of $36 trillion in assets. Just that little social network of theirs with 36 counterparties, which AIG is at the center of, is a total assets involved of $36 trillion. But it's just one of many overlapping complex derivatives networks with all of their linkages, and the sum total of all the derivatives, credit swap derivatives, we're not talking about other categories, just credit swaps, according to the latest statement of the Bank of International Settlements, the BIS, is 28 times larger than AIG's total credit default swaps at its peak. So it seems to me that no matter what the government does and no matter how much the government spends, it's never enough. And yet, as we demonstrated in our paper 6 months ago, and as we show in this paper again, it is already much too much. It's too much for the system to spend that much money. It's unreasonable. It's beyond what I call the threshold of absurdity. Hidden in an obscure corner of the derivatives market is a unique credit default swap that virtually no one is talking about. It's not a contract on the demise of General Motors. It's not a contract on the demise of Citigroup or any other corporation. It's a contract that's very actively traded on the default of the United States government, the U.S. Treasury Department. Now, quietly, without fanfare, a small but growing number of investors are not only thinking the unthinkable default, they're actually spending money on it. They're spending money to buy insurance contracts to protect themselves from that very unlikely event. And everyone's goal seems to be to prevent the unpreventable, to jury-rig the cycles of history and try and make things happen that can't happen. And what they're really trying to do is turn back the clock and go back and reverse the blunders of the past. They can't do that. Or they come out and say, no, what we really want to do now is repeal the law of gravity, which means, in financial terms, means we're not going to let the sellers sell. We're not going to let the prices fall. We're not going to let the markets go down. And you can't do that. You just don't we don't have that power.